These 8 states are quietly taking up to $3,000 from retirees each year, and most seniors have no idea they are even on the list. The list became shorter in 2026. One state, West Virginia, officially ended its tax on Social Security benefits on the first day of January. That leaves 8 states that still collect money from your benefit check before it reaches you. But here is the part few people mention. Even in states that recently repealed the tax, some retirees are actually paying more this year than they did last year. Not less, more. Because a separate rule written into federal law layers on top of every state rule. And the combined effect in the wrong state can quietly remove between $1,000 and $3,000 a year from a retiree's budget without ever appearing as a separate invoice. Most retirees do not notice the charge because the state does not label it a tax on Social Security. It is folded into the standard income tax return as a taxable portion of benefits. You only recognize it when you run the numbers. And when you do, it is often already too late to reverse the decision that pushed you past the threshold. By the end of this video, you will know the exact 8 states still on the list for 2026, how each one determines whether your benefits are taxed, the 2 separate income thresholds the federal government applies on top of every state rule, the 1 new deduction Congress added in 2025 that offsets part of the impact for anyone over 65, and the 5 strategies that can reduce or eliminate this exposure before the next tax year ends. Mark here, with over a decade inside the financial system watching retirees get surprised by rules that were never clearly explained. Today's rule is one of the most overlooked because it is largely invisible. Most retirees living in these 8 states do not even realize their state taxes Social Security until the year they discover they owe. Therefore, the first step is knowing whether you are on the list. There are actually 2 completely different ways a state can access part of your benefit check. The first group is the easiest to understand. 4 of the 8 states apply a flat percentage to the portion of your Social Security that is already taxable at the federal level, regardless of how high or low your total income may be. Those 4 states are Colorado, Utah, Montana, and Minnesota. If you live in one of these 4 and any portion of your Social Security appears as taxable on your federal return, the state will automatically include a share of it. Colorado is a common surprise because the state often markets itself as retirement-friendly. Colorado applies a flat 4.4% tax rate. Retirees age 65 and older can deduct the full federally taxable portion of their Social Security. That sounds straightforward, but the overlooked detail is this. Retirees between age 55 and age 64 can deduct only up to $75,000 of retirement income if single or $95,000 if married filing jointly. Therefore, any early retiree receiving Social Security before age 65, which is common for those who claimed at 62 to bridge a gap year, faces the full 4.4% on the taxable portion until the year they turn 65. For a couple receiving $30,000 a year in benefits with 85% federally taxable, the Colorado impact before age 65 is over $1,000 annually, and many do not notice it until filing. Consider the pattern of a Colorado couple in their early 60s. One spouse retired at 62 and began receiving Social Security early. The other continues working part-time for health coverage until Medicare begins. Their combined income sits slightly above the $75,000 single filer retirement deduction threshold because the working spouse's wages alone exceed it. Therefore, the full 4.4% Colorado rate applies to the taxable portion of the early claimant's Social Security. Over the 3-year gap between early claiming and turning 65, the family pays more than $3,000 in state tax on benefits that would have been fully exempt with different timing. That money does not return once they turn 65. It is simply the cost of receiving Social Security in Colorado before qualifying for the full deduction. Utah is next. Utah applies a flat 4.5% income tax. There is a Social Security benefits credit, but it phases out at higher income levels. Full exemption is available only for adjusted gross income under $54,000 for a single filer or $90,000 for a couple filing jointly. Therefore, a Utah retiree whose combined income from a pension, part-time work, and required minimum distributions exceeds the threshold loses the credit entirely. For a couple just over the $90,000 line, the state tax on benefits can reach $1,400 per year on income already taxed federally, up to 85%. Montana taxes Social Security similarly to the federal method, which sounds simple until you see that Montana uses income thresholds that have remained unchanged for years. The base amount is only $32,000 for a couple filing jointly or $25,000 for a single filer. Those thresholds were set decades ago and never adjusted for inflation. Therefore, many Montana retirees with any additional income have up to 50% of their benefits included in the state calculation. The Montana rate on that portion can reach 5.65%. For a couple receiving $28,000 in benefits with half included, the Montana impact is close to $800 annually. Not overwhelming by itself, but it adds to everything else. Minnesota is the fourth flat rate state and also the most detailed. Minnesota offers a subtraction that fully exempts Social Security for couples with adjusted gross income under $18,320 or single filers under $84,490. Below those levels, no state tax is owed. Above them, the subtraction begins to phase out, and the state impact increases quickly. About 29% of Minnesota beneficiaries still pay state tax on their benefits. That is nearly 1 in 3 retirees. The average cost for those in the phase-out range falls between $1,200 and $2,200 annually. Therefore, if you live in Colorado, Utah, Montana, or Minnesota, and your income exceeds the exemption limits mentioned, the state may collect part of your benefit each year. Most retirees in these 4 states do not receive a separate notice. The tax is built into the regular state return. The other 4 states operate differently. The second group includes Connecticut, New Mexico, Rhode Island, and Vermont. These states do not apply a flat rate. They use adjusted gross income thresholds. If your income stays below a set number, none of your benefits are taxed. If your income exceeds that number by even $1, the taxable portion opens and the state begins collecting. Many retirees cross these thresholds not due to routine income, but because of a one-time event, such as a Roth conversion, a larger required minimum distribution, or the sale of property. A single significant taxable event can move someone over the line and trigger state tax on benefits that were exempt the prior year. Connecticut begins taxing at $75,000 of federal adjusted gross income for a single filer or $100,000 for a couple filing jointly. Above that level, up to 25% of Social Security benefits may be included in state taxable income. The limit applies to the percentage, not the dollar value. A couple with $120,000 of adjusted gross income and $36,000 of Social Security benefits could have up to $9,000 included for Connecticut tax purposes. The state tax on that portion can approach $600. New Mexico sets higher thresholds. Single filers earning less than $100,000 or couples under $150,000 can fully deduct Social Security. Once income crosses those lines, the deduction generally disappears without a gradual phase out for many filers. This creates what is often described as a cliff. $1 above the threshold can mean hundreds in state tax because the deduction does not taper. Rhode Island exempts Social Security only for retirees who have reached full retirement age and whose adjusted gross income is below $117,000 for most filers or $133,150 for couples filing jointly. Early claimants may see their federally taxable portion included for state purposes until they reach full retirement age. Vermont fully exempts benefits for joint filers with adjusted gross income of $70,000 or less, or single filers at $55,000 or less. A partial exemption applies up to a higher phase-out level. Above that, the federally taxable portion is taxed at Vermont's regular rates, which range from 3.75% to 8.75% depending on total income. Therefore, the second group of states creates timing considerations that the first group does not. You may remain below the threshold for years and then exceed it in a single year due to one financial decision. Even if you live in one of the 42 states that do not tax Social Security, the federal government may tax up to 85% of your benefits. This rule appears in Internal Revenue Code Section 86 and has existed since 1983. The income thresholds that trigger federal taxation have never been indexed for inflation. They are $25,000 of combined income for a single filer and $32,000 for a couple filing jointly. Combined income equals adjusted gross income plus tax-exempt interest plus half of your Social Security benefits. Above the first threshold, up to 50% of benefits may become federally taxable. Above the second threshold, $34,000 single or $44,000 joint, up to 85% may be taxable. Because these figures were set decades ago, many retirees with moderate additional income fall into the 85% range. The interaction between federal and state rules is where the total impact appears. A retiree who does not review these numbers annually may pay between $1,000 and $3,000 more than necessary. There are 5 commonly used strategies that can help manage exposure. The first is planning higher income events in lower income years, such as the period between retirement and starting Social Security. The second is reviewing domicile if relocation is already under consideration. The third is carefully timing Roth conversions with professional guidance. The fourth is using qualified charitable distributions after age 70 and a half to reduce adjusted gross income. The fifth is planning the timing of required minimum distributions to avoid stacking income into a single year. The 8 states taxing Social Security in 2026 are Colorado, Utah, Montana, Minnesota, Connecticut, New Mexico, Rhode Island, and Vermont. West Virginia has ended its tax. The federal government may tax up to 85% of benefits above long-standing thresholds. The senior deduction introduced in 2025 provides additional relief at the federal level for many retirees but does not change state rules. Review your most recent state return and identify whether any portion of Social Security was taxable. Then, consult a qualified tax professional before year-end to project your income against both federal and state thresholds and determine whether any of these strategies apply to your situation. Act before December 31st.